In this video, we're going to analyze stock ticker symbol SDGR, SCHRODINGER. If you know the proper way to pronounce it, please comment below. As always, we're going to take a look at the monthly chart first. That's our highest time frame. As you can see here, there's a monthly area of demand, pretty wide, but that's in control. And so price dropped to it and now forming this green bullish candle. It's a piercing candle, only 10 days into the month, and it's already formed this very strong green candle. So we're expecting price to rally from here. It has been rallying, but we're expecting it to rally all the way back up here to this $80 price range. Let's zoom in closer to see what we can find out. On the weekly chart, we have this zone that's in control, this zone that is smaller right here, playing out nicely. Alright, so some people have asked how to draw the zone. How do I draw the zone? I say, draw the zone from the proximal to the distal line. So the zone is drawn from, so you have a rally, base rally, so you draw the zone from this proximal line, the zone from here and from here. If you only have one candle at your base, then you would draw the whole, you would take the whole thing. You would take this and this if there wasn't this candle. Okay, so in a nutshell, that's how you draw the zone. So going back to the analysis, we have this weekly demand zone that it bounced, price came here, bounced off of on. So this is kind of, in a sense, giving us the confirmation that price may reverse from here, and it's okay to take lower demand zones off of these bullish candles, especially since this week closed with a very strong green engulfing candle moving to the upside. So let's zoom in even closer to see what we can find out. So we see that on the daily, price has touched this level, kissed the level, and rallied, and then it has formed a new area demand zone right here because price reversed from here. So then this one I would draw, if I could just delete this. So this one I draw with the candles like that. The price has created this zone, so this is a very good zone to go long if it wants to retrace from here. Let's zoom in even closer. Let's say your entry time frame is the 4 hour. So what do we have here? We have this zone that is pretty wide. So this one we can narrow it down even smaller. But when you narrow it down so small, there's a smaller chance of it actually touching down here. It may just react to the weekly bounce, bounce up here, and may not even get down to the wicks down here. So when you do the lower time frames, it's, first of all, your zone is smaller. So your zone is smaller and more narrow. So the chances of it penetrating that deep inside of it is smaller, and your zone is more narrow, so there's a chance that it could overshoot it. So there's two chances that it may not even reach that zone, or if it does, it may overshoot it because the amount of buffer that you give it, or that it's set at, there's not enough buffer. So that's the downfall to trading the smaller time frames. But what you can do with trading the smaller time frames is you can take new zones. So let's say that a new zone formed here. This is not a zone, by the way, but I'm just saying that let's say if it did form there because you have price, creating very strong areas of demand, created new zone right here, then it's okay to take this zone. Okay, so that's the positive of these smaller time frames, is that you can take the smaller zones. But me personally, I like to take the larger zones just because I have a full-time job and I don't have time to stare at the charts all day or every 4 hours. Okay, so that is it for this analysis. If you got value from the video, please consider subscribing to the channel and click on that bell so you get notified of new videos I release in the future. I make daily swing trading videos on stocks and forex using supply and demand. If you like the video, please hit the thumbs up button. It helps with the YouTube algorithm. I want you to transform your charts into profits and build the life you love.